The idea of a global bank tax is once again in the headlines after the G20 group of finance ministers met again in Germany this week. And Michael Iannaccone of MDI Investments, along with Rebel Cole of DePaul University, are here to talk about it. Welcome again.
Thank you.
Thank you.
So some countries around the world are opposed to the idea of a global bank tax. Michael, why?
Well, because some of them, like China and Canada, didn't have any banks that caused any problems, and they're like, why should the good banks be taxed with the bad banks? And you know, I'm opposed to the bank tax because I think it's just taking money out of the banking system that can be there for capital and be there for lending. If you tax the bank more, then you're just taking extending the recovery.
Okay, on the other side, governments of the United States, England, Germany all support a global bank tax. Now, even the International Monetary Fund came out with two proposals in recent months saying that banks should pay a tax to finance future bailouts, and they could also have a tax on profits and compensation. Rebel, what is the worst that can happen if you tax on profits and compensation at the very least?
Well, the worst thing that you can happen is you can put in perverse incentives that actually provide the banks with incentives to increase risk rather than reduce risk. It's absolutely the wrong thing to be doing to taxing the banks. The proper course of action is to increase the capital requirements, which is what an amendment passed by the Congress last week, introduced by Senator Collins, does. It raises the capital requirements on the big banks. Now, why are these countries in favor of it? Well, I think everyone you just named are running record budget deficits, and they're looking for revenues from anywhere they can get them.
Michael, the idea of raising capital requirements, is that good enough? Is that what is going to solve the problem of banks taking too much risk?
Well, you know, banks are supposed to take risk, but they're supposed to be rewarded for it. And I think if you're going to raise the capital standards for the big banks, I think everyone has to play on the same level playing field. And I think I would even go one step further. The governments, not only the U.S. government in having Fannie and Freddie, but other governments around the world, there's other entities that operate like banks but are not actually banks, and they're allowed to operate with lower capital standards. If you act like a bank, then you should have to follow the same capital standards as if you were a bank. And then that would reduce the amount of leverage that's out there. It would also reduce the high-risk loans that banks made to cause the problem.
And go ahead, Rebel.
Let me point out that most of these countries already have a bank tax. It's called the deposit insurance premium. Virtually every country in the world that has deposit insurance has a tax on banks. In the U.S., it's a risk-based deposit insurance premium. It didn't work very well in the last crisis, did it? So why do we think another bank tax to deter risk is going to work? It just won't.
Then do we need to fix or change the risk-based, those premiums that go to the FDIC? Do we need to increase those?
There's only one way to end too big to fail, and that's to make banks that are too big to fail smaller. Now, increasing capital requirements is one way to do that by essentially it's a tax on the banks that forces them to hold more capital, so it's less profitable, so they have less incentive to be so large. Another thing is simply to put a hard and fast cap. There's already a size limit of 10% of deposits in the U.S. Why not lower that? 5%,
well,
3%?
You shouldn't get rid of too big to fail by reducing the size of the banks. I mean, the capitalism is you grow as large as you want. Let one of the banks fail and see what the market does with it. I mean, we had the same problem in the 80s to the early 90s. There were 3,000 banks that failed then, and we didn't run out in this panic and try and create and TARP and everything. We handled it in a manner, and they let certain banks fail, and then the market dealt with the banks failing. If you would have let Citicorp fail one of the 3 times that it should have failed, you know, the market would have done something with Citibank. The market would have eaten up pieces of Citibank, and we would have had a little bit of a depression, and then the market would have come back.
But the government's not going to let that happen. Even in the future, there is so much systemic risk that is still existing with our banking system, even after the financial crisis.
And that's because Wall Street owns K Street and owns the capital.
There's no political will to break up the banks. That's not going to happen, Rebel.
It's getting worse. They're now trying to gut the derivatives regulation and every other important aspect of this bill. We're going to end up with nothing.
We have government entities that understand the banking crisis. We have the FDIC. We have the Fed. They were given powers when they were started. Give them back those powers. What? The public knows better in the banking industry than the FDIC and the Fed does?
I think in the end, though, guys, in the end, we still have a banking system that can do some of the same bad things as it did before the financial crisis started. Yes or no, Rebel?
Yes, and it's going to happen sooner rather than later.
Yes or no?
Yes, it can do the same thing, but the next financial crisis is not a real estate crisis. It's an investment securities crisis.
Okay.
So anything you do now is not going to fix the next crisis.
Okay. Scary, scary for all of us. Thank you very much. Michael Iannaccone of MDI Investments and Rebel Cole of DePaul University.
Thank you.